For the acquired company, the important thing is to know is what is the impact to the acquisition? How long do they have coverage for? What happens the day of the acquisition? And the important part of the D&O policy for that is what's called the discovery clause. Pretty much it says if your D&O policy were to stop right now, how long do you have coverage for? Usually it's a 1-year period, and how much does it cost? The cost could be anywhere from 125% to 200%, and you want that discovery cost to be as little as possible. For the acquiring company, that aspect of the policy doesn't matter. What they have is what's called a midterm acquisition threshold, and basically what that says is if they were to acquire another company, there's automatic coverage going forward as long as that company is some percentage, usually it's 10% or 15% or as high as 25%. You want that midterm acquisition threshold to be as high as possible to allow you to acquire as big a bank as possible without there being a cost implication. For healthy banks, every insurance carrier sees them all the same. A healthy bank is a healthy bank. But not every insurance carrier identifies a distressed bank the same way. I've had a bank recently where one carrier was looking to offer a full regulatory exclusion, another carrier was looking to offer a 3-year policy with no regulatory exclusion because they saw that bank differently. So it's very, very critical for a bank that may be considered distressed by anybody is to get them in front of the underwriters. Part of our process is the underwriter meeting. We get all the underwriters in a room or a call together, and we have them ask questions to the bank, and the bank responds to the questions, and the bank can even do an introduction before that. And the important thing is they are our best asset. They are our best ability to tell their story. And they want the D&O underwriters to recognize them as more than just the public filings. So it's important to get them, any bank that may perceive as distressed, to get them in front of the underwriters. For a healthy bank, well, that's a great aspect, and it's good to get them in front of the underwriters. For them, it's important of getting them every possible coverage enhancement. They're a healthy bank, they've done a great job. There's usually anywhere between 15 and 30 coverage enhancements. They don't usually cost anything, and these healthy banks should know they should be entitled to every one of them. Mergers and acquisitions, what are the newest trends? What am I hearing? And honestly, the newest trends are simply, there's so many of them. Even as far back as 2 or 3 years ago, maybe 50 or 60% of mergers and acquisitions were resulting in some kind of investigation or lawsuit. Now it's 95, 98%. It's not a matter of if, it's a matter of when. The cost of these suits are not material. They range from $300,000 to $2 million. So really it's impacting the primary D&O carrier and has no impact on the excess D&O carriers, but it's everyone. It's cost of doing business if you're going to do a merger or acquisition. Every policy, or almost every policy, that a bank owns is going to protect both the company's corporate balance sheet as well as the personal assets. But there are different insurance products that are available to protect just the assets of the individual directors and officers. They can range from a thing called A-side insurance, which protects all of the individuals and doesn't share with the entity. That could be then limited in scope to what's called independent director liability, which just protects the independent directors. And finally, there's a policy called personal director liability, where for the other coverages, the named insured would be the bank. For personal director liability, the named insured is the individual, and it protects them for all the boards they're on. I'm smiling a little bit because I get a question a lot about civil money penalties, and I've been doing this for 16 years now, either as an underwriter or as a broker. And for the first 15 years of that, never had a question about it. And now in the past year, this is all I'm getting, is civil money penalties, what's the deal? I've done a lot of investigations, and we're kind of still a part where we don't have a finite answer. About 1.5 years ago, the FDIC had brought some citations against 2 banks about having the coverage, the civil money penalties coverage on their policy, even though the directors had paid for it. And we're still in a place where there's a regulation which states it should only be covered by the individual directors. And we have carriers offering this coverage which should protect it for everybody. What we're recommending to our customers is to have the directors pay for it themselves. We see an average cost of $25 per director to up to $100 per director. We feel that the benefit of having the coverage, even if it just protects the expenses associated with the civil money penalties, is better than not having the coverage at all. AH&T has partnered with Bank Director to offer D&O liability policy audits to your bank. The audit report includes positive aspects of your policy, areas of recommended improvement, limits benchmarking analysis, and highlights the ideal process. It also includes a summary for your board.